Hey guys, it is May from Markets with May. And one second, right up against the AC, so it's super loud here. Hopefully, you guys can still hear me over this. I'm going to do JP Morgan today. And JP Morgan reported earnings, and it was totally exactly what I anticipated, which was that it would crush it off of the heels of purchasing First Republic. And I mean, this is ridiculous as far as what goes, and that's despite the fact that I am long JP Morgan and will probably stay long JP Morgan this entire time, because the $2 billion gain that they have off of First Republic, I don't believe that's the end. I'm just going to say it like it is. Disclosures, and let's jump into it because I do have a hard stop. I have some friends in town today, so I'll be enjoying the beautiful weather that New York City, now that it was thunderstorms this morning, but beautiful now. Past performance not indicative of future returns. I am long JP Morgan along with a bunch of other banks, and I will be talking about what I'm taking away from JP Morgan for other financial assets out there, and then we'll do Q&A. Also, I wanted to mention that I will, let me look at the chats and see, I can see some of the things. Also, I will be doing a preview of the banks later today. Maximus, you're so funny and silly. All right, let's get into it then. JP Morgan on the quarter. One second. So the top line and the most important thing with JP Morgan is the degree to which they blew it out. I mean, there's really no other way to say it. If you look at it, you have revenue up 34% year over year, and you have earnings, down here, up 67% on net income. And because they have a negative share count on the quarter, meaning they did do some buyback, you have EPS diluted up 72%. This was a great quarter, but what I would say is that they did raise guidance. A bunch of this came from First Republic, which I'll go through in a second. And your real risk, if you're short JP Morgan or if you're anything but long JP Morgan, is that if there's no recession, given what I saw on the quarter, this thing will 100% rip. He is still being crazy conservative with his cash, such that this thing has a lot of extra capital in it to rip. And let's actually talk about that. What exactly was the benefit of First Republic? Now, I had said this so many times. He claimed that he only had $1 billion in accretion on this deal, and I was like, no, baby, there's no way. Like, there's no way that it's only $1 billion of accretion. Maybe like $1 billion of immediate accretion, but given that the purchase of Silicon Valley's assets were a $10 billion worth of estimated accretion for First National, I think it was FCNCA, whatever. There's no way that First Republic, with better credit quality, better assets, lower default rate, was going to only yield you $1 billion in accretion. And this is not it. This is just what they took on the quarter. I still think, and I'll show you exactly where and exactly why, that there's still massive gains to come. So let's read the slide. Essentially, this was right underneath all of the stuff that was reported. Some people got it wrong, that were trying to cover the quarter. They were focused on other things. $2.6 billion. That's what they made in net income on the quarter. But they would have only done $339 million if it wasn't for First Republic. And we're going to talk about why that is. First Republic's very profitable. It was one of the most profitable banks. So it doesn't magically become not profitable just because of this run-on bank situation that affected their capital base, not the things that they were investing it in, and certainly not the amount that they were charging for the loans themselves. Okay. So basically, the other $2.3 billion came from First Republic, which is why I feel like, and have been this entire time, frustrated as a shareholder and a little bit upset that people are so aggressive with me on Twitter Spaces when I was talking about this, and how they're like, but it went bankrupt, so of course the shareholder gets zeroed out. I'm like, no, if you go bankrupt, usually some lawyer comes in and liquidates those assets and you get a piece of them, depending on where you are in the cap line. This tells you there was nothing wrong with those loans. It was just it's just all held to maturity risk. Okay. And we'll go through that. But so the estimated bargain purchase gain of 2.7 billion attributable to First Republic. Net revenue was 1 billion. Okay, so the net revenue of 3.7 billion, 2.7 of that was First Republic. Now I just got to actually take it off because you got to understand this. 3.7 billion worth of your revenue, 2.7 came from First Republic, but First Republic is a significantly smaller bank than all of JP Morgan. Okay, JP Morgan, just on the asset management business, to give you a sense for it, which I will show you later, JP Morgan Asset Management has $3 trillion in assets. First Republic only had about 270 million. Okay, it's 270 billion. Sorry, 270 billion versus 3 trillion in assets under management for just the asset management business, just to give you a sense for how much smaller First Republic is than JP Morgan. But all that revenue came in from what? First Republic. A huge portion of that revenue was just buying it and immediately accreting it. So there is that. Okay. Now let's actually look at everything else here. 4 divisions at JP Morgan. I'm going to go through them on the ones that annoy me the least as a previously First Republic shareholder into its insolvent moments, let's call it. Okay. Asset management, private wealth. I knew that they were going to crush it here because it is very hard. The size, again, of First Republic was about 268 billion, something like that, 270 billion-ish. So the fact that they made great revenue off of First Republic, 100%, right? Because they bought those assets so on the cheap and they got a huge private wealth business that they would not have been allowed to acquire otherwise, so that now they have $3.2 trillion in assets. That's up 16% year over year. Now, again, some of that is from just taking in the First Republic assets. Some of that is from the fact that the markets have been up since the debacle that we saw earlier this year. So realize that that is a huge component of what is going on in those numbers. Okay, I want to show you this because this is where it starts to get really annoying. You're going to see across all of these different numbers this provision for credit losses. And I'm going to tell you now, and I'll show you very clearly, First Republic usually has credit losses that are around 0%. That's their historical credit losses. And yet we're seeing credit loss provisions taken everywhere for First Republic. I'm no fool, and I told you this before. The most likely thing that they would do with this asset purchase is use the purchase to do a series of accounting things that would allow them to provision more for credit losses, because as a just in case, they didn't take enough credit losses on the other parts of the bank. And that's what I see. At least that's the argument that I'm going to make. And let's see it. But here you can see that right there. There shouldn't be any credit losses in the asset management business, and yet they're taking an equivalent amount of losses that they would on the reported business. So all of the 3.2 trillion, only 300 billion of which is First Republic. They provision 145 in credit costs, which is primarily reserves for credit, whatever it is. And somehow First Republic, the tiny little piece of it, has the same amount. Okay. What is that all about if it's not you buffering for the rest of the bank? And just so you know, here's the provision that they took. They took another 2.9 billion for credit losses. I'm going to show you why it's like not. It gives them so much potential spring if we are all wrong and there is no recession in the back half, or the recession is limited with low credit losses. Okay. Other things I just want to show you. Okay. Again, small business, but is adding 2% to the return on equity for all of JP Morgan private wealth. This was a very good purchase because the clients were good at First Republic. They're just good clients. There's nothing you can do. So net income on the asset management business up 10% year over year. Very strong quarter. Sequentially, it looks weird. I'm not even sure why that is, quite frankly, because with the First Republic stuff, this should have done great. But given how the market's been performing, I'm not worried about asset management going forward. Okay, next piece. Consumer and commercial, net income up 61%. Now, this is where First Republic totally benefited from them. Okay, totally benefited them. So remember, and I just want to make sure you guys can understand this. So I pulled up, I am providing, here is First Republic's final quarter, if we will, okay? It's from there. I think you can still pull this off of the website. Some of the documents of their past reports have been removed from the website. But if you look at this, you'll see that total investment securities is 33.5 billion. The total book of loans was 208 billion. And you will need that to make sense of all these numbers that are in the commercial banking and commercial and corporate banking sections. Okay, so commercial, corporate investment banking revenue, that's not a First Republic business. So that's up 10%. The fixed income markets, that's down. Trading is down for the quarter. That's not anything crazy. This bodes well up here at the top. This bodes well for all of private equity, period. Okay. So go back to my videos on private equity. I have a special video for that. I'll tag it down below. It also suggests that you're going to have a very specific look at Morgan Stanley and Goldman Sachs. So the banking business is already starting to recover. That's fantastic. And then the trading business is going to look like a hot mess. Hence, you should still have a lot of volatility in Goldman Sachs and Morgan Stanley, which report immediately next week. So that's that. However, this second line item, payments, this means that companies are not having any problem paying it back. Okay. So right now, corporate health is strong enough, at least for a JP Morgan, which is going to have the bulk of large business expenses or large business customers and debt associated with that. That business is still going very strong right now. Not a problem. And very important, it's benefiting from the fact that the rates are higher. So overall, I anticipate seeing this in Morgan Stanley, Goldman Sachs, but it's too hard to tell. Goldman Sachs has slightly bigger percentage of revenue coming from the banking business. Morgan Stanley is more asset manager, smaller banking business, but both of them have approximately the same size trading business. So let's see how it goes on that. But these numbers for banking, for me, were better than expected. It's always hard to say what the street might think on that. Sorry. Now let's go back up here to the corporate. This is consumer and commercial banking. So here we see something very interesting. This was by far one of the strongest businesses because they took in First Republic. Okay. And there are a couple different things I really want to highlight on this because for whatever reason, I don't know if the analysts just want to keep this to themselves or what, they need to talk about this. Net income up 61%, revenue up 31%, is 100% buying in First Republic. But again, First Republic is small. It's $202 billion worth of loans. Okay. Now, if you look at it, home lending, you can kind of see private wealth. Home lending is doing just fine. Okay. Banking and the wealth portion of the commercial banking also doing doing fine. Credit costs 408. Charge-offs for change in allowances 408. That's what they're taking. Okay. But that doesn't make any sense for a company like First Republic unless you're just going to pretend like you're taking the held to maturity portion of some of those loans or something like that. Because again, I'm just going to show you this. This was in their deck. They typically don't have charge-offs. Okay. They just don't have charge-offs. Their historic annualized charge-off rate is 40 basis points, less than 1%. And you're going to take this really big number in a single quarter off that business that doesn't lose money for the most part. It doesn't charge, it doesn't have to write off and why doesn't it have to write off? Again, we talked about why it doesn't have to write off in previous episodes. The reason First Republic never had to write off assets is because the type of client base that they were lending to had a very high loan to value ratio. In some cases, it was over 50%, or actually their average was over 50% in the residential space. And then it's over 40% in commercial space. Okay. So it doesn't actually make sense to think that they wouldn't have any reclamation value, that when they repossess the properties, that they don't end up being able to sell them for more. And so that's the story that was always the story of First Republic. So then taking off this $500 million charge off is like completely loco. Okay, so that's why I'm saying number one, JP Morgan most likely taking it preemptively, not for the First Republic business, which will more or less look like it's disappeared after a few quarters, but for the business in general, so that the treasury function can have more capital on the off chance that they didn't provision correctly elsewhere. So that's the first place that you see it, is in this part of the quarter. Now you look at the net charge-off rates, and again, it says what May has been saying all along. The First Republic charge-offs are a joke, right? So we actually have a 0.2% gain recovery rate, in other words, from the First Republic piece, but you do see a slight increase in charge-offs, 0.07 versus 0.04. Year over year, it's slightly better. That said, this crazy low, given in theory, we're supposed to be in a rough environment. So I'm not sure why, but we're getting massive charge-off, which does, by the way, lower taxes. So that may be the reason why. And then credit, this actually is probably the most important facet, is that the card services net charge-off rate was 2.4%, and that is up, okay? That right there is something that will matter for a ton of different things. A 2.4 net charge-off rate is closer to the historical charge-offs, but you got to remember that JP Morgan has slightly higher credit quality. So that 2.4 charge-off, now we're going to be watching Discover Financial next week, Synchrony Financial, American Express, and Capital One. Those are your biggest consumer credit guys, okay? American Express, a little bit of a different animal. They tend to have very high quality customers. Nonetheless, they have grown their capital, grown their client base. So we're just going to be watching them. But Discover and Synchrony both took larger reserves for credit losses, but we'll get to see what's happening. They tend to have the lower end of the spectrum, and Capital One is right down the middle. So those three will be watching. I would say that if you still have stuff there, that's going to be fun for the traders as relates to that number, because that number it's bigger. That's the only thing that I would mention that is downside that you should take a look at. Okay, here we talked about this already. This commercial banking has a First Republic piece to it, and again, this 608 to me makes me a little bit bonkers. Overall, commercial banking, let's do the top numbers first. 54% on net income, so huge gain. What is that gain coming from? That gain is coming from net interest income. Rates have risen, and so all of the roll-off of stuff from before where you were only making 2-3%, every quarter they're going to make a higher percentage rate on net interest income. That's going to drive margins upwards, okay? The other thing that's coming from is how they're dealing with First Republic, which is essentially they're going to start amortizing. And given what they purchased it at, the amortization off the loans on First Republic alone should yield them a ton of money. I don't know another way to say it, okay? Revenue up 42%, also really big. But I really, again, want to show you how stupid what's going on is, right? So they went ahead and took this charge right here of 608, right? It's 608 million. And then they're saying that it's a reserve build of 389 million and then other kind of credit costs. Okay. But let's just talk about that for a second. Because what precisely was what are they reserving off of just First Republic if it's not the loans from First Republic? But that doesn't make any sense given what I showed you on net credit losses. Because let's say that, first of all, the credit losses in residential, not a big deal. Multifamily, also right now, especially given where First Republic is, not a big deal. Like the market is more than clearing on loans that are 40% loan to value, et cetera, et cetera. I think with multifamily, it's closer to 50% loan to value for most of the loans off of the December presentation that they did to investors. Okay, let's actually take a look at what exactly is the commercial piece, because I'm sure a lot of you are like, oh, May, it's the commercial. You're just being a little bit of like mean to them for no reason. Let's actually talk about that. This, again, was from the 2022 piece, and you can see that commercial real estate is only 6% of that book. So they're taking about a 5% mark, the 608. If you want to give them half of it, it's 2.5% mark on a bunch of loans that are 40% loan to value approximately is what they used to quote. 40% loan to value, and you bought them at a discount. That to me is absolutely the treasury function of the bank, just doing a little touch up on whatever it needs for the rest of the bank, because that's a big number for what they've historically done. And you can see right here, net charge-off recovery rate right this minute on the commercial side of the business, only 0.02%. Now, strangely enough, the recovery rate on the core business actually 0.15%, meaning that despite whatever it is that people are saying is going on, JP Morgan, when it goes on the commercial business for defaulting loans, somehow manages to sell off those assets and make money. And, you just get a baby hair loss on the First Republic business. Given that you're then going to do a bunch of charge-offs or loan loss provisions on that business, you got a lot of capital, and you got a lot of capital going in the second half to fuel anything that might be going on the investment banking side. Additionally, he even said this on the call that private lending is going to be next level. And as soon as we get through some of this. So that again helps with the thesis that I've had on Blackstone, to a lesser extent, Apollo and KKR. I think all three of them do great, but Blackstone goes into the quarter way higher stacked. And then the last thing, I just want to show it super cleanly. If you look at First Republic, there was a part where they just flat out told you what they took for loan losses for First Republic. Hopefully I have it here. If not, let me get it on a different screen. Yeah, here we go. First Republic bargain purchase 2.7 billion, right? So it added 91 cents to EPS just on the purchase, guys. That's not on the revenue that First Republic continues to make going forward, nor is it on the amortization going forward of the loans that they bought at a discount, nor is it on just people paying back the loans that they took out because they don't go bankrupt or anything, okay? That is 91 cents right out of the gates. Okay. The credit reserve build that they're taking for First Republic, which has zero credit losses and is really only a $200 billion book of loans plus $333 million, so $2.3 billion of assets. They're going to reserve $1.16 billion. Why? That's crazy. And then the net investment security piece of it, 900 million. So let me show you those numbers so you don't think I'm lying. 33 billion net investment securities. They're going to take 900 million as potential losses for that, held to maturity losses, which by the way, probably will end up just being amortized over the course of 5 years. And then here's the second piece, net income, credit reserve for First Republic, 1.1 billion off of $208 billion worth of loans. So they're going to provision 5%, makes no sense. That's what I'm saying. Hence, that's why I have the feelings I have on this. And it means pretty much that the First Republic purchase alone will fuel the earnings of JP Morgan for quarters to come. They did raise guidance as a result. If they didn't raise guidance, I would have thought they were crazy pants. And really, right now, they are setting up as if the second half of the year will be in a recession. And let's just call it what it is. If it's not in a recession, JP Morgan has the most capital to do a bunch of stuff in private lending and investment banking, which will allow them to be hella profitable. Okay, there aren't really any questions except what's my nationality? Maximus. You're so funny. I am Chinese Portuguese. That's what I am. So hopefully that does it for you. And with that, I am going to go ahead and sign off and go see my friends. If you are seeing this on replay, feel free to put comments down below. Also, I will post a link to my financials playlist here after this goes into replay. And also, I will be reporting throughout the quarter on what I'm seeing in the financials, which right now looks really good. Bye, guys. Have an awesome weekend.